Friends, let us discuss the important marginal costing concept with multiple choice questions. So let us start with first question, and it says, is a costing technique wherein the marginal cost is charged to units of cost. So it is nothing but the marginal costing, right? Marginal costing is a costing technique wherein the marginal cost is charged to unit of cost. Here question can be asked like, marginal costing is a dash of costing, so it is a technique of costing, right? In this way question can be asked like, marginal costing is dash of costing, so it is a technique of costing. And for this question, marginal costing is a costing technique, so here option A is the right answer. Let us move on the next question, and it says, is the change in total cost when the quantity produced is increased by 1? See, friends, sentence says, is the change in total cost when the quantity produced is increased by 1. So if the sentence says, if we increase the quantity of production by 1, and if the total cost increases, that amount is known as basically marginal cost, right? So here option B is the right answer. See, friends, here question on marginal cost can be asked like, marginal cost is the cost of one additional unit or one extra unit, right? Or the cost of producing one additional unit is known as dash. So the cost of producing one additional unit is known as marginal cost. So here make clear the concept of marginal cost. See, marginal cost is the cost of producing one extra unit or one additional unit, right? See, to understand the concept, let us take an example. Suppose the total cost of producing 100 unit of certain product, total cost of producing 100 unit of certain product is, let us say, 5000 rupees. Okay, so total cost is 5000 rupees and units produced are 100. Now if we produce one extra unit, that if our production increases from 100 to 101, so we are going to produce one extra unit. So obviously there will be change in the total cost, which is 5000. If the total cost is 5050, right, if total cost is increased by rupees 50, then we can say that the marginal cost in that case is rupees 50, right? So basically marginal cost is the cost of producing one extra unit or one additional unit, right? So for question number 2, here marginal cost is the change in the total cost when the quantity produced is increased by 1. So here option B is the right answer. Let us move on the next question, and it says, it asks us about the equation. Okay, the equation here is contribution is equal to sales minus. See, friends, this is one of the basic formulas or equations in the marginal costing, that contribution is equal to sales minus variable cost, right? When we subtract variable cost from sales, we get contribution. So here question can be asked on this equation in various ways, like the excess of selling price over variable cost, or excess of sales over variable cost, is known as contribution. In this way question can be asked. So particularly for this, contribution is equal to sales minus variable cost, so here option D is the right answer. Let us move on the next question, and it says, contribution is equal to fixed cost plus. See, friends, this is another important formula of contribution. You must memorize these two formulas. First one is contribution is equal to sales minus variable cost, and second one is contribution is equal to fixed cost plus profit. See, contribution is equal to fixed cost plus profit, and if there is a loss, then formula becomes contribution is equal to fixed cost minus loss. If there is a loss, the equation will be contribution is equal to fixed cost minus loss. But now here, in particularly in this equation, equation says contribution is equal to fixed cost plus profit. So here option B is the right answer, right? Let us move on the next question, and next question is about the basic marginal cost equation. And as I said that you have to memorize the formula of contribution, so you can relate here that the sales minus variable cost is basically contribution, right? When we subtract variable cost from sales, we get contribution. So first or left hand side of this equation of the equal to sign, it says that sales minus variable cost. So sales minus variable cost is nothing but the contribution, right? Now let us come on the right hand side of the equation, and here says fixed cost plus profit. So we know that this is another formula of contribution, that contribution is equal to fixed cost plus profit, right? So here if we subtract variable cost from sales, we get contribution, and if we add a profit in fixed cost, we get contribution, right? So this is basically the uh, basic marginal costing equation or basic marginal cost equation, right? So here for particularly for this question, sales minus variable cost is equal to fixed cost plus profit is a basic marginal costing equation. So here option B is the right answer. Next question asks us, says is the difference between sales and variable cost. So again the question is about the contribution. See, the sentence says is the difference between sales and variable cost. So we know that when we subtract sale variable cost from sales, we get contribution. So here the question can be asked like this on the contribution, right? So here option C is the right answer, that is uh, contribution is the difference between sales and variable cost. And as I have already mentioned that here question can be asked like that, excess of sales over variable cost is also contribution, right? Excess of sales over variable cost, right? So for this question, contribution is the difference between sales and variable cost. So here option C is the right answer. Let us move on the next question, friends, and it says marginal costing classifies cost as dash cost and variable cost. See friends, marginal costing classifies cost as fixed cost and variable cost. And while studying uh, and while applying the various formulas, it ignores fixed cost basically, right? But here marginal costing classifies cost as fixed cost and variable cost. So here option B is the right answer, right? Sorry. Let us move on the next question, and next question says cost remains fixed irrespective of volume of production. So this statement says that this cost remains fixed. So we can relate that it is nothing but the fixed cost, right? So here option A is the right answer, that is fixed cost remains fixed irrespective of volume of production, right? So here option A is the right answer. Now let us move on the next question, and next question is on the fixed cost, and it says fixed cost per unit dash when the volume of output increases. Friend, read the sentence carefully. Sentence next part of the sentence or second part of the sentence says when the volume of output increases. See, if the volume of output increases, fixed cost per unit will get decreased. That see how. So you can say observe that this is becoming this statement is becoming the contrary. Okay, like fixed cost means we assume that it remains fixed, but see friends, fixed cost per unit changes, it doesn't remain fixed, right? Fixed cost per unit changes. Now let's see the options, and we'll discuss about that in the next question. So particularly for this question, fixed cost per unit decreases when the volume of output increases, right? So here option B is the right answer. To understand this, see friends, again take a situation where the total production is at present is of the 100 units. Okay, the total production is 100 units and fixed cost is 1000 rupees. Okay, so total production 100 unit, fixed cost 1000 rupees. So what will be the fixed cost per unit? Right, we can calculate fixed cost per unit as total fixed cost divided by number of unit produced. So here we have taken a situation where fixed cost is 1000 rupees and number of unit produced are 100. So 1000 divided by 100, it will be 10 rupees. So in that situation, fixed cost per unit will be 10 rupees. Now relate this sentence to that second part of this question. When the volume of output increases, now see, if the volume of output increases from 100 unit to 110 unit, right? So now firm is producing 110 units, but as fixed cost remains fixed irrespective of volume of production. We have discussed about that. Fixed cost remains fixed. It doesn't depend on the volume of production. Now, as our fixed cost is 1000 rupees and now we have increased the production to 110. When we divide the 1000 by 110, so obviously fixed cost per unit will get decreased, right? So now I hope the this question and the answer to this question is clear now, right? So here option B is the right answer, that is fixed cost per unit decreases when the volume of output increases, right? Now let us move on the next question, and next question asks us which of the following statement is not true regarding fixed cost. So the sentence says which of the following statement is not true. Now let us see what are the options. First option says fixed cost remains fixed if production increases. Yes friends, this statement is true that fixed cost remains fixed. We have discussed that fixed cost uh, remains fixed irrespective of volume of production. So if production is increased, there will be no change in the amount of fixed cost. So first option or first statement is true. Second statement says per unit fixed cost increases if production decreases. Right, now read this sentence carefully. Sentence says per unit fixed cost or fixed cost per unit increases if production decreases. Yes friend, if the total production is decreased, then fixed cost per unit will go up, right? So now here let us read the question number 9 or sentence of question number 9, which says that fixed cost per unit decreases when the volume of output increases, right? Per unit fixed cost will reduce if the output is increases, and fixed cost per unit will increase if production is decreases, right? Now let us move on the next option, and it says fixed cost cannot be zero. Yes friends, fixed cost cannot be zero. There can be a fixed cost in the every organization, right? It cannot be, or it can never be zero. Like see here, I would like to tell you the example of fixed cost, examples of fixed cost like the factory insurance, okay, then depreciation on plant and machinery, and salary of top level managers. So these cost remains there irrespective of volume of production, right? So fixed cost cannot be zero. This statement is also true. Now last option or last statement says fixed cost per unit always remain fixed. So this statement is not true. Here we have discussed that fixed cost per unit will decrease. Now here in option B, fixed cost per unit increases. So fixed cost per unit can never be fixed, right? And this statement says fixed cost per unit always remain fixed. So this statement is not true, right? So here option D is the right answer, that is fixed cost changes as per the not fixed cost, let me correct it, fixed cost per unit, right? Fixed cost per unit changes as per the volume of production, but fixed cost remains fixed, right? Total fixed cost remains fixed, but fixed cost per unit changes, right? So friends, see, this is the beauty of marginal costing, right? So now I hope the concept related to fixed cost and fixed cost per unit is also clear here. So for particularly for this question number 10, which asks us which of the following statement is not true regarding fixed cost. So the question option number D, that is fixed cost per unit always remain fixed. This is not true. So here option D is the right answer. Let us move on the next question, and it says fixed costs are considered as, and options are product cost, variable cost, period cost, marginal cost. See friends, in example of fixed cost, I have discussed that the depreciation, rent, insurance charges, those are the example of fixed cost. So you can relate this to the options that fixed costs are basically related to a specific time period, that we take the insurance policy for a specific time period like for month or for year. Similarly, we pay rent for month, or we can pay the yearly rent, right? Or the salaries or depreciation, we charge depreciation per year. So fixed costs are considered as period cost. So here option C is the right answer, right? Fixed costs are considered as period cost because they are related to specific time period, right? So here option C is the right answer. Next question is about the variable cost, and it says variable cost are considered as, so now see friends, variable cost are considered as product cost because variable cost varies or variable cost changes as per the volume of production. And examples of variable cost are like direct material, direct labor, and direct expenses. These are the examples of variable cost, right? We can relate that the cost of material will be high if the production is high, and cost of material consumed will be less if the production is less. So variable costs are basically product cost. So here option A is the right answer. And variable cost varies as per the volume of production. We are going to discuss about that in next questions also. Next question asks us, when volume of production increases, total variable cost. See friends, statement or sentence says when volume of production increases. If we increase the production, so obviously total variable cost will also increase because the material, as we discussed, that material used in the production is the example of variable cost. So if our production is increased, then obviously total variable cost will also increase. So here when volume of production increases, total variable cost also increases. So here option B is the right answer. Let us move on the next question, and it asks us which of the following statement is not true about variable cost. So now let us discuss these statements one by one. First statement says variable cost per unit remains fixed. Yes, friends, variable cost per unit remains fixed, right? But total variable cost changes as per the volume of production, right? So here again you can make the clear the concept of fixed cost and variable cost. We have discussed about fixed cost, that fixed cost per unit changes but total fixed cost remains fixed, but variable cost per unit remains fixed, right? Because see, to produce the one product, whatever material required, it will be fixed. If we produce one unit, certain amount of material will require. If we want to produce another unit, then again we have to use the same quantity of material, right? So variable cost per unit remains fixed. This statement is true. The second statement, variable cost varies as per volume of production. See friends, this is also true. We have discussed it in previous question that variable cost varies as per the volume of production. If volume of production more, variable cost will be more, right? So second statement is also true, or second option is also true. Next, third statement or third option says variable cost increases if production decreases. Now read this option carefully. It says variable cost increases if production decreases, see, if production decreases, variable cost also decreases, right? So basically there is a direct relation between production, volume of production, and variable cost, right? When production increases, variable cost also increases. So this statement, option C, is the contrary statement to this. So here this statement is not true. And fourth statement or fourth option says variable cost can be zero if there is no production. Yes friends, variable cost can be zero, but we have already discussed that fixed cost cannot be zero, right? So friends, see here in one question, in particularly in this question, the 4 5 multiple choice questions can be fed. So if your concept is clear, you can answer any question if it is twisted, or if uh, uh, it is asked in another words, right? So the uh, understanding of the concept is very necessary, a very important thing, right? So now let us move on the next question, and next question says is known as gross margin, and options are marginal cost, contribution, variable cost, fixed cost. See friends, contribution is basically known as gross margin. So here option B is the right answer. See friends, contribution is one of the important concept in marginal costing. So you have to uh, understand the concept of contribution properly and the various formulas related to contribution, because 100% 2 3 questions can be there in your exam on the contribution, right? So particularly for this question, contribution is known as gross margin. So here option B is the right answer. Next question says when contribution is equal to fixed cost. See, sentence says when contribution is equal to fixed cost, the firm. So we have understood the formulas of contribution again. That first formula is contribution is equal to sales minus variable cost, and second formula is contribution is equal to fixed cost plus profit, right? Now if contribution is equal to fixed cost, then there will be no profit, no loss, right? So here option C is the right answer. When contribution is equal to fixed costs, right, there is no profit, no loss. So here option C is the right answer. Let us move on the next question, and it says PV ratio is a ratio of contribution to. So we know that the formula of PV ratio is equal to contribution divided by sales multiplied by 100. So here PV ratio is the ratio of contribution to sales. So here option C is the right answer. Next question says a high PV ratio indicates high profitability, obviously, right? So here option B is the right answer. A high PV ratio indicates high profitability, and low PV ratio indicates low profitability, right? So here option B is the right answer. Let us move on the next question, and it says which of the following can increase the PV ratio, right? So we have discussed in previous question that high PV ratio indicates high profitability. Now, if organization wants to increase the PV ratio, then how it can be increased? And here options are increase in sales price. So now, see friends, we have discussed already that PV ratio is basically the ratio of contribution to sales. If contribution is increased, then PV ratio will be increased or will get increased, right? So first option says increase in sales price. See, if we increase the sales price, ultimately contribution will go up, or it will increase, and it will lead to increase in the PV ratio. So if we increase the sales price, PV ratio will increase. Then second option says reduction in marginal cost. See, if we reduce the marginal cost of variable cost, see friends, marginal cost is also known as variable cost. Okay, so in this way also multiple choice question can be asked, like marginal cost is also known as variable cost. Now our second option says reduction in marginal cost. Yes, if we reduce the marginal cost, then obviously our PV ratio will go up. Then option C, increase in contribution. Yes, if we are able to increase contribution, then PV ratio will be increased. So here all of these three are the ways to of increasing the PV ratio. So here option D is the right answer. Next question says the dash is a point at which total sales revenue is equal to total cost of the output. See friends, read the sentence carefully and you will easily find guess the answer. That it's a point at which total sales revenue is equal to total cost of the browsing. If the total sales revenue is equal to total cost, it means there is no profit, no loss, and this point is known as break-even point. So here option A is the right answer. Let us move on the next question, and next question says at break-even point contribution is exactly equal to. See friends, now again the question is related to the contribution. So we discussed that break-even point is a point where there is no profit, no loss. Now this sentence says at break-even point contribution is exactly equal to what? So it is exactly equal to fixed cost, right? So if contribution is equal to fixed cost, there will be no profit, no loss. I think we have discussed this MCQ in previous slides also, right? So for particularly this question, at break-even point, contribution is exactly equal to fixed cost. So here option B is the right answer. Next question says, sales over and above the break-even point are known as. So the sales over and above break-even points are known as margin of safety. So this is the important one of the important concept of marginal costing. Basically sales over and about the break-even point are known as margin of safety, where firm can earn the profit. So here option A is the right answer. Next question says the angle formed at the break-even point is known as. See friends, this question is related to the graphical representation of break-even point. So we know that we can calculate the break-even point on the graph or graphically. So the angle formed at the break-even point is known as, basically this angle is known as angle of incidence. So I am going to show you the angle of incidence in the next slides. Now just memorize that angle formed at the break-even point is known as angle of incidence. So here option B is the right answer. Next question says at dash sales line and total cost line intersect each other. So where total cost line and total sales line and total cost line intersect each other, or sales line and total cost line intersect each other, it is the point, basically the break even point. So here option C, the break-even point, at break-even point, sales line and total cost line intersects each other, right? So now, as this both these both questions are related to the graph and graphical representation of the break-even point and marginal costing. So we are going to discuss about the this break-even analysis, okay, on the graph. So see friends, here the cost and sales are shown on the y-axis, and units are shown on the x-axis here. And see this line is the total sales line, basically, which is starting from 0. This is total line, and here fixed cost line is parallel to x-axis, right, at the bottom. So because we have discussed that fixed cost cannot be 0. So there, this is the parallel line, and this is parallel to x-axis because fixed cost remains fixed irrespective of volume of production, right? So this is fixed cost, and from the fixed cost we draw the marginal cost line, right? And this is the marginal cost line, and if we draw that marginal cost line, so it intersects the sales line, and the points formed at the intersection of total cost line and margin sales line is known as break-even point. Basically this is break-even point, and angle formed at this point is known as angle of incidence, right? So now I hope that concept of angle of incident and the break-even point on graph is also clear. So friends, thank you, thanks for watching. Make sure that you have subscribed the channel, like, share this video with your friends, and let me know in the comment section if you have any question, or if you want to uh, have a video on other topics, so that I can make video on those topics. Thank you friends, thanks for watching.